What's up, Poppers? This is Mikey Millions here in collaboration with Nedmonds Productions, and we are proud to present the first in a new series designed to share the rich culture and history behind the wonderful world of investing. As fiends for the dollar, every one of us plays a fundamental role in spinning the cogs of this machine we call the market. This entire world of finance deserves to be celebrated. So, in this episode, we're going to kick things off by exploring the history of investing so that we may all develop an appreciation for where we came from and where we are now. Let's get underway. First of all, investing simply means expending some capital with the expectation of making some sort of profit on it. In that context, investing is as old as the human race. Caveman Grog more than likely gave some deer meat to Cub so that Cub could go hunting on a full stomach. And then if Cub came back with some dead game, he would share a nice hunk of goat flesh with Grog. That initial piece of meat that Grog gave up was an investment. But we've come a long way from swapping dead animal flesh. Millennia later, the modern origins of investing began to emerge. We're going to focus on a particularly interesting practice that was common in ancient Greece and Rome. Making trade voyages around the Mediterranean could be a very profitable profession for those who could pull it off. But taking a Greek cargo ship from Thessaloniki to Tyre carried a lot of risks. There were problems with navigation, risks of capture, bad weather, Hydra and Scylla, accidents, plus the risk of just coming back with a bad set of trade goods. Making a trade voyage was not cheap, and it was certainly risky, so those who sought to make their wealth by seafaring began to establish arrangements with people back home. If those people back in Greece would help fund these maritime trade missions, then the trader would share his profit with that financier when he came back successful. That arrangement is clearly what we would call an investment, and the outcomes sound familiar to us today. If the trader came back with a great set of goods and made a killing off them, then the investor would be greatly rewarded. If the trader made it back home but was not able to turn a big profit, then the investor would receive meager payouts. And if the ship left port and was never seen again, the investor would suffer a loss of his whole investment. Naturally, skilled traders would raise funding while offering smaller returns for his investors. Meanwhile, unproven sailors would need to offer a much greater cut of their profits to find financiers. Sounds a bit like a bond market, doesn't it? All of these seafaring companies lasted a single voyage. After the investor was satisfied, the relationship would dissolve, and any more voyages would start up fundraising again. This type of practice went on for a long time, and although empires rose and fell, the basic practice of giving investors a cut of a company's profit remained. The next major change to investing emerged in the 16th century when the world's first exchange opened in Antwerp, Belgium in 1531. Although there was no such thing as a stock in the late Renaissance, men of means would come to the Antwerp exchange to issue bonds and engage in financial partnerships. This concept of establishing relationships with investors for as long as the business lasts, rather than dissolving the relationship whenever a particular mission ended, paved the way for a major shift in the years to follow. When we pick up in the next episode, we'll dive into how this change really moved the needle and set the foundation for the markets we now know and love. What's up, Poppers? Welcome back to the history of investing. We left off in Antwerp, Belgium in the 16th century. In this episode, we will see how the practices of the Antwerp exchange spread to the rest of Europe, and how these investments led to tremendous maritime power for the players involved. Throughout the 16th century, the British, Dutch, and French East India companies changed the game. These companies ran trade voyages to the East Indies, modern-day Southeast Asia, to trade in spices and other exotic goods. But just like our Greek example, the risks were relentless, and to spread the risk of a bad voyage, these companies solicited investors with promises of reward when the trade was successful. But unlike the old way of dissolving the investor relationship after every trade mission, the East Indies companies issued actual stock that investors could hold indefinitely. And rather than receive a one-time payout from a successful trade mission, the shareholders of these companies would receive periodic dividends to enjoy the bounties of not just one trade mission, but every trade mission that took place during the dividend period. The companies could then issue more shares, use the investors' money to build a larger fleet to run even more missions, and build even greater wealth. I'm sure much of that sounds familiar. That was the start of the wonderful stock trade that we all enjoy and love. And as a side note here, this is the first time we encounter the word stock in the context of partial entitlement to a company's profit. But stock also refers to the frame used to support a ship when it is under construction. Could it be that buying stock in the East India Company stemmed from the idea that an investor was buying into the company's ability to build ships? That's just my speculation as to the origin of the word stock in this context, but it makes for good headcanon. Anyway, back to Imperial Europe. Since the East India Companies issued stock on literal paper certificates, these shares can then be traded amongst investors. However, there was no central meeting area where buyers and sellers could meet. There was no stock exchange. The UK did not have its own Antwerp, so people who wanted to sell shares would have to shop around and advertise their intent to sell. Likewise, buyers would have to track down a seller, which made the process inefficient and unreliable. Coffee houses and bars ended up being the places to trade shares. But such public trading had a very interesting effect on the industry. People publicly saw investors in the East India Companies make a boatload of money by doing nothing but collecting dividends, so everyone wanted a piece of that spice cake. As a result, new companies could publicly sell shares to every thirsty scrub in a coffee house, and the stock issuing industry started booming. But this led to a problem that may sound familiar even today. Companies, most notably the South Sea Company, issued stock to aggressive investors who were just dying to get their hands on some shares. And due to investor demand for risk, these companies would sell all their shares before even sending a ship off to the Indies. Now, sitting on what would be the equivalent of presumably millions of dollars today, the South Seas Company and others like them lost their business plan to the hype. With no real accountability to an SEC, companies could just sell shares to raise money without ever really performing a trade mission and just give dividends to old investors with money from new ones. This was much like a Ponzi scheme at its worst, or at its best, companies with a little more integrity that feared getting tarred and feathered would simply focus on the wrong things. Instead of focusing on running trade missions or building a fleet, the companies would instead drop stacks to stock their offices with exotic hardwood furniture and fancy Rembrandt paintings. This led to more than a few other so-called companies with multiple patents pending on turning iron into gold, hitting the coffee shops to sell shares, and they all got bought up. The first list of stock tickers appeared at Jonathan's Coffee House in 1698 when gentleman John Castawing posted a list of stocks and their prices titled, "The Course of the Exchange and Other Things." Things were so out of hand that they couldn't even come up with a better title. Eventually, this bubble burst once people realized that companies were not actually doing anything except selling stock, and their shares crumbled into dust. Governments decided it was time for some rules on who could issue shares, all but shutting down the shenanigans. The stock issuing industry continued at a limp in Georgian London for many decades, but unbridled desire for money cannot be contained by simple laws. And besides, the people making the laws wanted to own shares too. So rather than completely shut down the investing industry in England, it was simply hamstrung. But here's the deal. What better way to keep an eye on investors than to have them all meet at one place? Enter the London Stock Exchange in 1773, where investors finally had a place to meet and trade while protected from fraud. By 1801, the London Stock Exchange was a fully functional system where brokers paid a fee to participate in a finely regulated marketplace. Although we may call Antwerp the world's first stock exchange, London is the birthplace of what we would recognize as a proper exchange today. In the next episode, we will take the next step toward modern markets, showcasing how the London Stock Exchange set the stage for even more robust markets to come. What's up, Poppers? Welcome back to the history of investing. We left off in London, England in the early 19th century. In this episode, we're going to see the effects of the London Stock Exchange and how it propelled us to where we are today. London set many of the trends and norms that continue to dominate securities trades today. But the 19th century was a busy time, and good ideas in Europe quickly traversed the Atlantic and took root in the nascent countries and territories of North America, most notably the US. Much like everything the United States does, the US saw the tightly regulated stock exchange, took the idea, and made it better. On May 17, 1792, a group of 24 rich guys in top hats signed the Buttonwood Agreement, a landmark arrangement that decided the rules that would apply to securities trades in New York, including commissions and a dealer treatment. The magnum opus deserves to be read in full. We, the subscribers, brokers for the purchase and sale of the public stock, do hereby solemnly promise to pledge ourselves to each other, that we will not buy or sell from this day for any person whatsoever any kind of public stock at a less rate than 1/4% commission on the specie value, and that we will give preference to each other in our negotiations. In testimony whereof we have set our hands on this 17th day of May at New York, 1792. In short, the Buttonwood Agreement arranged that the New York brokers would only trade with each other, and they would charge their clients 0.25% commission. This arrangement effectively eliminated price competition among brokers and ensured ample liquidity in the marketplace because it consolidated the brokers to one location, the New York Stock Exchange, initially situated under the shade of the Buttonwood tree where they signed the landmark agreement. But without a building of their own to host the NYSE, the brokers spent quite a bit of time running their businesses out of the Tontine Coffee House at 82 Wall Street. By 1793, it was the premier location in New York to trade, hear the news, fight, debate, or host a ball. The Tontine was the perfect nursery for the NYSE, but by 1817, the party had outgrown its venue. The brokers operating out of that space refined their rules and regulations further and developed into the New York Stock Exchange Board, which they decided needed a larger home. They rented out some space in other New York buildings, but they were either destroyed by fire, too inconvenient, too expensive, or just straight up no fun to hang out at. It wasn't until 1865, a whole 48 years and one civil war later, that the New York Stock Exchange found its home on its famous block. The NYSE's adoption of the telegraph and merger with a startup exchange called Open Board of Stockbrokers cemented the NYSE as the premier exchange on this side of the Atlantic, and arguably already the entire world. Today, the New York Stock Exchange makes it home at 11 Wall Street, behind a facade of white Georgia marble. Hosting 2,400 listings with a combined market cap of over $30 trillion, it is by far the largest exchange in the world, moving more than $200 billion a day between buyers and sellers. As the world gets smaller and digital exchanges like the NASDAQ continue to gain steam, the world's appetite for exchanges may change, but certainly will not go away. These days, almost every country has a stock exchange of its own. Many of them act as a proving ground for domestic companies as they pursue aspirations to be listed on the major European exchanges like the London Securities Exchange or the Euronext, and eventually make the big leap to the US securities exchanges like the NYSE. So folks, there you have it. A crash course in the history of investing, from proto-cavemen sharing goat marrow all the way to the global securities trade across continents. Let us know what you think in the comments and any other topics you'd like to see covered. Thanks for watching, and we'll see you next time.